All right. Welcome to each and every one of us. And first off, I want to congratulate you for taking the big step to paying for this masterclass. The major truth is this. One of the ways to check people's involvement in something is to check how committed they are to the point of paying for that thing. Now, a lot of people found out that this group was, just an easy group because they found out that it was an easy group because, we brought people together and we brought people together and, we started teaching people. At some point, in fact, the very first day that the group was created, I gave out a free signal on Volatility 75.1S, and some people actually ran into profits. It was crazy. So a lot of people began to feel entitled. And that is one major problem that people have, and that is what is hindering them from being successful when they meet opportunities like this. A lot of people began to feel entitled. That's why you see on the group that people start asking, please, when will you drop signal? Do you get it? Now, the regular trader, every trader, if you're a trader, if you've been in trading, the business of trading, you would know that signal groups are very, very expensive. Do you get it? Signal groups, there are some signal groups that you have to pay as much as who is this Guillory's iPad? I'm trying to mute this person. Okay. All right. So signal groups, there are signal groups that pay as much as $50 for a month, $100 for a month, right? Some people pay as much as $1,000 for 1 year. Do you get it? And now when people began to ask the $5 masterclass, is it going to be a signal group and all of that? Come on. Where have you seen a signal channel for $5? Do you get that? Now that brings to your notice that should come bring something to your notice that we are not just here to give you signals basically, because if we actually wanted to give you signals or we wanted to run a signal channel, we would have created a signal group and tell you to pay $50 for a month or $100 for a month. Do you get it? So now you have to understand that what we are doing is something that is just of help to you. Basically, you cannot go anywhere to find out that you are being trained for $5 on how to trade the market, basically. Do you get it? Now we have courses, we have we already have full courses that we're selling for $250. We have materials that we're selling for $80. I'm talking about our ebooks, basically. Do you get it? So what is $5 to us? Do you get that? So this group is not just a group that, we want to give you signals. If you want to give you signals, you won't be paying $5. Do you get it? So I want you to take advantage of this privilege. This is a privilege that people are actually looking for. This is a privilege that people are actually looking for to come into learning how to trade the market at little or no cost, basically. You're one of the most advantaged and privileged people in the industry currently, to have all of this wealth of knowledge at your disposal at little or no price at all. So first thing we're going to be talking about tonight, we'll just be talking about a brief introduction. This is not the Forex market. If this was just the normal Forex market, the usual Forex market, I would have been talking about things like EUR/USD, been talking about different currency pairs and all of that. But this is far from the Forex market. This is not a regulated market. This is synthetic indices market. Basically, this is the indices market, and it is not even part of the regulated indices. These are assets that are created on algorithms, basically. So you need to have a basic understanding of what these things are before you can delve into trading them. I know that everyone here wants to make money, but the truth is, if you don't have the foundational knowledge of what you are going into, you will actually go to meet the mirage in front of you, basically. So to talk about the introduction to synthetic indices, basically, I'll be bringing up my friend again, Mr. Lawal. Is going to just do a brief overview, and then I'll go into talking about trading psychology, and then I'll show you something on Boom 1000. I told you guys I'm going to show you guys my power strategy. I'm going to show you guys how I actually catch spikes on the market. And I'm going to do that once I finish talking about trading psychology. And I'm going to talk about trading psychology once my friend is done talking about the introduction to these indices, basically. All right, to you, Mr. Lawal. Thank you very much.
All right. Good evening, everyone. I'll be introducing you guys to what these things are. I know a lot of people know volatility indices and we trade it and all that. Well, do you really know what you're trading? You know, if we were trading Forex, you know you're trading maybe the GBP pairs, that's the Great Britain pair, you're trading it against the USD, GBP USD. Or if you're trading NASDAQ, you know you're trading what's going on Wall Street stock. Or if you're trading commodities or gold, you know gold, you know oil, you know all these things physically. But volatility indices, what are you trading? What exactly do you think you're trading? A lot of people just go into it and they just want to see money, but they don't really know what they are trading. They don't know what they are trading. So I'll tell you what this is. Now, synthetic indices. Synthetic indices are unique indices that mimic the real world market volatility. And then they're actually liquidity risks that are often seen in other financial markets. Now, what do I mean? You are trading the volatility of real world markets. You are not trading, you are not trading tangibility, you are not trading gold, you are not trading silver. But what you are trading now is the real world market volatility, what's going on in the world. That's what you are trading. And now they are available 24/7, of course, you all know that. And then synthetic indices have actually been traded for more than 10 years. And then you'll be able to learn some precise trading niche. Now, what moves synthetic indices? In Forex, the prices of currency pairs are moved by the law of supply and demand. What's the law of supply and demand? Once buyers come into the market, it pushes price upward. And as price go upward, there's excess supply. And once there's excess supply, what happens? It makes price to go up. No, once there's excess demand, it makes price to go up. For example, a particular man, he's selling a shoe. And then for that shoe, he has limited supply of that shoe. And so many people are hungry for that shoe. They need that shoe. They want to get that shoe. They like that brand. But he has limited supply. What does the man do? Since he wants to maximize profit, he increases the price of the shoe so that he can maximize profit. So there's limited supply, but the price goes up. And that's what happened in Forex pairs. There's limited supply of currencies, and so that's what pushes the price up. And once it's now in excess, then it starts dropping. Once the demand is now and once the supply is now in excess, then price starts dropping. That's how it is. But it's not like that in indices. Indices are moved by algorithms. They are moved by algorithms. They are not moved by who is buying and who is selling or whatever. They are moved by algorithms that are created, independent algorithms. In fact, Deriv, in as much as they know these algorithms, it was created by them. The algorithms are independent of them. According to them, it's independent. So this is what moves the price of volatility indices. Now, I'll let you know why I prefer volatility indices to currency. And I prefer it because, of course, I can trade in the synthetic indices anytime. Monday to Friday, it moves 24/7. There are no negative balances. I can start with low trading capital. I mean, I can literally grow $2, $4, $5 to thousands of dollars. But on currency pairs, you start seeing it's impossible to take a particular trade. It show you leverage impossibility. You can't do this, you can't do that. You can't even open standard lots. You can't open lot sizes that you want to. In fact, if you're opening the smallest lot on some currency pairs, you'll be seeing some ridiculous amount of money that you yourself will not want to have. So those kind of situations discourage me from actually trading. So I prefer indices, and I've made much money. In fact, I've traded currency for years before I started trading, so I can tell the difference between that. Now, a lot of people already know all this. So now let me quickly say something here. I think I wrote something down I want you guys to know. Let me check it out. It's about your risk level. Where is it? Hold on. It's about your risk. Okay, let me say this before then. I'll give you some tips for trading Deriv, just minor tips. Like I said, I'm just doing the introduction. Tomorrow I'll take my part of this master class. But let me give you some tips for trading Deriv. Number one, you need to start small. Start with little capital. In as much as I keep saying, and I'm talking of little capital, does not mean some people will fund $5 and $10. We do that because we have mastered the market. But if you're a newbie, I don't think you should be starting your account with $5 or $10 until you have virtually gotten your feet wet. Even $20, it's still shaky for newbies until you've gotten your feet wet and you know what you're doing, until we've properly groomed you before you can actually start funding $20, $15, $10, and you hope to make $1,000. No, it's not. You're not robbing the bank. You need to start with reasonable capital. At least $50 is okay. $60, $70 is okay. $100 is also okay. That's what I mean by starting small. So you need to start small, and then also you need to manage your money wisely. Don't let your emotions overwhelm you. Don't there's something we call revenge trading. If you notice, I gave a signal in the group today, and then it went in profit. Then immediately I told everybody to lock it, and then it kicked us out in profit. The same thing happened yesterday. A normal person driven by emotions, these things happen. It's not like it doesn't happen. A normal person driven by emotions, because he made at least $2 loss or $3 loss, he want to recover it quickly, and then he'll go and panic buy or panic sell. That's what they call revenge trading. You are trading with your emotions. Things like that, you just stay off and you wait for your markup to find out again. So you do not panic buy or panic sell on those situations. So also, there's profit potential in all the volatility indices, in all of them. Step index, volatility 7500, all of it, there's profit potential. And when you are in doubt, you sit it out. You don't rush when you are in doubt. I posted something in the group also, that you also need to become restless as the market. You only become restless when you are sure of what you're doing. But if you are in doubt, I don't see any reason you should become restless. Today I was in doubt, so I didn't rush any trade. I didn't tell everybody, go and start buying, or go and start selling, or go and do that. I had to sit it out because I'm in doubt. I'm expecting something in the market, and until I see that, I'm not going to enter the market. That's how I learn discipline, and that's how I don't burn my account. I do not rush because it's already moving, it's leaving me out. Now there's something that is going to affect a lot of people, which it does. It's called FOMO, fear of missing. Once you see a particular move and then you miss it out, and then you see it going your direction and it's really going your direction. Let's say you're supposed to buy and it's really going your direction, and then it's buying massively and you miss it out. You have this fear of missing out. You feel so pained, you feel so angry, not knowing that the market exists forever. All those kind of situations will make you panic buy, to play with your emotions, and that's what you should avoid. You should avoid that. You shouldn't, because it's doing such. You just leave the market. That's when you are in doubt. But when you are sure of that, now, this is what I do. I take only major trades. Let me say this now and say it once and for all. I take only major trades. The reason why I was looking for minor trades for you guys, why I posted yesterday and today, was because I wanted you guys to make money before weekend. I wanted you guys to see what it looks like to make profit. Normal me, I don't take those kind of trades. I don't even trade. I can do without trading for weeks because I take only major trades, because all my major trades produce at least, you can ask my friend here, Basi, all my major trades produce at least $1,000. And I don't remove less than that from the market. I don't remove less than 1,000, at most even $500. But I don't remove. There was a time I took an account of $4,000 a day on the market. So if I'm taking that kind of profit, Why do I need to rush to enter the market all the time? And you can only take those kind of profits when you take major moves, when you take major trades. So volatility in this is too volatile for you to trade every day. It's like you mixing 100% alcohol on how will I put it, or you mixing two toxic things together and trying to consume it. You can't consume two toxic things together, to kill you. So you can't be trading volatility in this every single day. It's too volatile for you to do that. So I take only major moves, and then those major moves produce massive returns. Swing trades, they produce really massive returns. That's why I told you where I plan to buy volatility 75. In as much as it's looking like it's going bullish, I do not trust it. And I feel it might only go bullish this week and continue a massive bear trend by next week. And it will get to that point where we expect it to buy. In fact, that's what I see before it's so I'm not going to give a buy call that okay it's buying, so everybody start buying, because that's what because it's not going to last, and I don't like taking trades that do not last. And that's why I'm telling you guys to work on your emotions. You only take trades that are supposed to have. I only try to give signals because I wanted you guys to make money before weekend. So when you are in doubt, you see it out. And now the higher the returns, the lower the chance of a payout. Now this is where manipulation comes in. I told you guys I was going to tell you about manipulation, but I'll stress on it tomorrow, but I'll just say some things about it. Now, listen to me. Deriv offers a vast selection of trading opportunities, ranging from low-risk trades, V75S, and so on like that. V50, those are low-risk trades, with returns to 5 to 10%, to those with higher returns of 100% or more, like volatility 75, volatility 100, and all that. Now, Deriv prices trades based on mathematical probabilities. That's the algorithms, I'm telling you now. Their prices trade on mathematical probabilities now. And of course, unexpected events do happen. Now, what I'm reading out a part of conversations I had with one of his staff in Deriv. So you guys should really pay attention with this. This is a conversation I had with a staff in Deriv headquarters. So I'm letting you guys know what I had with them. So it's not all signal providers that have this knowledge. So I'm dishing out real knowledge to you guys about what you are trading. Deriv prices trades based on mathematical probabilities. Now, unexpected events do happen, but overall, if you are offered returns of more than 200% for a trade lasting for a day or less, just as an example, the reason for such generous returns is that the likelihood of that payout is very slim. Keep in mind that it's readily possible to mix and match your trades on Deriv. Now, this is what an executive in Deriv actually told me. What do I mean? The person said, if you are being offered returns of more than 200% for a trade on Deriv, that means they know that move. For example, the bullish move we're expecting now, Deriv knows it. And they know that people are going to see that trend. And that particular trade is going to produce about 200% or even more, far more than 200%, I mean. So they know that. And then the person now said that it is going to be the likelihood of payout for that trade is going to be fairly slim. What do they mean? That means that particular origin where we're going to buy, there will be so much ranges and consolidations that they would have kicked a lot of people out before the bullish move starts. If you check the overall weekly trend I showed you on Monday, if you check the overall weekly trend, you will see that there was no particular weekly candle that came up immediately and started bullish just like that. It had to take a process of ranging, consolidation, kicking retail traders out before it eventually started moving. Why? Because Deriv knows what it is. They know that this is a particular move. Buyers are going to be there. In fact, before V75 started dropping, as of last week or last 2 weeks, there was a particular point that was supposed to be the beginning of the bullish move. Deriv knew that, so it started buying for a while. And then it got to a point where it stopped buying and started dropping massively. And it kicked a lot of buyers out. So that point is a manipulation because they know that that's actually a buy origin. But then, because they expect a lot of people to buy, they'll buy that particular trade. They'll buy that particular setup a little and then kick a lot of people. In fact, they sell is usually bigger, huger candles than the buy. That's why the sell I'm actually expecting on VN5 is going to be far bigger than the bullish moves that you're seeing right now before it eventually starts buying. So this is a manipulation that you need to know. So you should keep in mind that it is readily possible for them to mix match your trades on Deriv. Tomorrow, I'm going to stress this further so you understand what I mean by manipulations. I'll show you on charts. But now I'm just giving you a brief overview of what you should know. I'll show you on charts on what happened of the 75 and what you should avoid. But today is just a brief overview of what you should know. So I'll hand over to the host of this event, and then I'll see you guys tomorrow. Basi.
All right, thank you very much, Mr. Lawal. Thank you so much. You actually said a lot, quite a lot of things that I actually wanted to talk about. You touched into them already. So what am I going to say? All right, so like I said, I'm going to talk about a little bit of trading psychology. And what I want to talk about first, and the reason why I want to talk about this is because everything that we are doing here at the Perfect Strategy is to make you a profitable trader. Now, some of us, we've heard about trading psychology before, and trust me, everybody knows that it is trader's mindset, Abby. You have to do this, you have to do that. Trading psychology is not a set of do's and don'ts. You get, it's not the rules and regulations of trading. It is having the right mental framework as to how you take your trades, how you manage your account, and all of that. Now, one of the very first things I'm going to let you know as regards trading psychology, the mindset of the trader is, first, you have to accept losses as part of the game. If you remember in the free masterclass we had, my friend Lawal said something, and it's my very, very favorite quote. One of the days I was just thinking, and we're just talking. Usually we have discussions on market, money, basically many of these things, and we're just in discourse. And I said, as long as the market remains, profit and loss will never cease. Do you get it? If you know economics here, you would know that there is something called the economic cycle, right? For every corresponding boom, there's always a crash. For every boom, there's always a corresponding crash. For example, look at Bitcoin. When Bitcoin moved from, I think, $700 to about $20,000 in 2017, do you get it? Bitcoin fell from $20,000 to like $3,000. Do you get that? And then now from $3,000, it was consolidating, moving up and down just around that level. And then sometime it got to around 6,000 and it dropped back to 3,000. And then it moved in 2020, I think, 2020, it moved to about close to 40,000 thereabout. Do you get? And then when it moved, it actually came down again, it dropped a bit. And then from there, it moved to 70,000. Do you get that? It moved to 70,000. 60,000 this year. And after that, another crash happened. From 70 or 60,000, it dropped down to, as at today, was ranging around 31,000. Do you get? So for every corresponding move upwards, there's always a downward move. That is to tell you how that profits and losses are inevitable.
Anele.
Sorry, who is that? Can you? Okay. All right. So profit and losses are inevitable. So first, you have to accept losses as part of the game. A lot of people don't like making losses. The truth is, nobody wants to make losses. But the truth is, everyone will. You get? There is no, there is nothing to do that will make you a winner 100% possible. Machines, in fact, the efficiency of every machine, you can't find efficiency equal to 100%. Do you get it? So as part of the things you need to understand is that losses are inevitable. And funny enough, trading with Deriv, I'm telling you, losses are inevitable. It is part of the game. Sometimes myself and my friend, we just laugh. Maybe when we enter a trade and it kicks us out, we just start laughing, oh God, what's wrong with Deriv? Like, we actually know that this is part of the game. And the reason why we're laughing is because we know that as far as there is a loss, we're also going to make profit. And then we sit down, re-strategize, go back into the market, look for good entries, go back into the market. Like you heard him say, he doesn't withdraw less than $1,000. Do you get? I've been in situations whereby I saw $700 profit and I left it because I wasn't satisfied. And in the end, the market went with the money. They gave me 700 and they took the money back. Do you get? I mean, this is how it is. Like, as long as the market remains, profit and loss will never cease. So first, you have to condition your mind to accept that losses are part of the game. But much more than the fact that losses are part of the game, you wouldn't want to be making losses every time. And so that's why we're here to teach you exactly how to overcome these losses. Understand that death is inevitable, right? Everyone would surely die. Everyone knows that. But the fact that everyone will surely die doesn't mean you should go and stand in front of a moving train. Do you get that? So there are preventive measures as to keeping yourself alive, even if you know that one day you will still die. Do you get it? That's the same thing with trading. Losses are inevitable, but there are things to do in order for you not to make losses all of the time. Do you get? Emotions are part of the game. I mean, that moment when you enter a trade and sometimes it's so bad that we enter the trade and sometimes I literally have to uninstall. I'm in a trade. I know what Deriv can do with that trade. I literally have to uninstall my MetaTrader and run away. You get it? Because I don't want to be attached to my device. Many a times you can be in a trade. This is still part of emotion. This is still part of the things that make people lose out in trades. Some of you have aborted your biggest trade ever. Maybe when the trade moved and it got to, let's say, $20, you close the trade. And then later on, you discover that if you had left that trade, you would have been in over $500, basically. It is all the work of your emotions. Do you get? And so part of trading psychology, you have to understand that the market, the competition in the market is not with anyone but yourself. You are fighting yourself. You are seeing money. You want to remove the money. One mind is saying, no, leave it. Do you get it? You have to overcome all of that. You have to master all of that if you actually want to be profitable, right? Now, there are times I've been in trades that, there are times that when I was trading Forex back then, there are times I open trades and that trade can be in loss for a whole day. I'll be seeing minus so and so amount, and it will be in loss for a whole day. Now, until it gets to my stop loss, I don't close the trade. Many a times, the market moves and it just down goes and consolidates, and all of a sudden it starts moving in my direction. Just imagine that emotions made me close the trade. I would have recorded a loss and I wouldn't have taken out of the profit that would have come later on. Basically, so you've been able to master your emotions, stick to the trading plan. If your stop loss, if you are to risk a certain amount of money on a particular trade, allow that risk to come through. Because many a times, this is the market. There are impulses and there are corrections. You may just be running out of the market too early. And then, like my friend said something about fear of missing out. The same way there's fear of missing out, there's also the same way of fear of losing out. The fear of losing. The fear of missing out makes you to jump into any random trade. The fear of losing makes you to exit a trade that would have given you profit. You get it? So you need to condition your mind that this is how this thing works. This is a game. For example, this is like every other skill. You are a doctor. You are in the theater and you're operating on a patient. And the patient is lying down there lifeless and it's as though the person is dead. Will you give up at that point? Will you take the person to go and bury? Why? Because the person is not breathing or not moving? No, you would finish the operation. If the person dies, okay, you know you are done with the operation. If the person doesn't, everything good. That is exactly how trading is. You need to stick to the rules. You need to follow your plan, sure that you are doing what is right. And then one other thing, your risk management. Basically, do not risk more than you can handle. If you know that $5 is too much for you to risk on a trade, don't risk it. The beginning of risk management is you being able to risk a particular, to risk risk based on your own risk appetite. There are some people that if they lose $1, they will be so disturbed. There are some other people, if they lose $1,000, they are not moved. Do you get it? So you have to risk what you can afford to lose. If you cannot afford to lose $5, don't risk it. If you cannot afford to lose $5, do not risk it. If you know you are still scared of staying in the market, go into the market with the lowest lot sizes. That's what's going to keep you safe. Do you get it? And then when you've been able to master the market, you can now start going in with bigger lot sizes and make more money. Do you get it? Trust the process, understand the process and all of that, and you remain profitable. Basically, this is it. Don't risk more than you can afford to lose. If you do that, you will be putting yourself under pressure. And one other thing, do not trade when you're on pressure. Now, I see a lot of people saying things like, oh, I have house rents to pay. I have this to do. I have this. See, the truth is, when you go into the market with that pressure, many a times, 90 out of 100 times, you would actually make a loss because at that point in time, you are not emotionally stable. Your mind is not at rest. So when people meet me and say, please, can you manage accounts for me? I mean, there was someone that met me this was last year, and was like, can you help me grow my account? And I asked him a question. Are you trying to meet up a demand? Okay, I asked him, when do you need the he said he was meeting me on Wednesday and he was like, he needs the account on Friday. And I was like, are you rushing up something? Do you want to meet up? He said, yes. And I'm like, oh, I can't do that because you are under pressure. And if I'm managing an account for someone who is under pressure, I myself have to be under pressure because the person will be pressuring me. Do you get it? So you yourself as a trader, if you want to actually be, do not try to trade under pressure. Do not try it. If you're under pressure, just calm down. The truth is that the situation will not spoil, it won't kill you. It is better you have your $50 and you trade later on and make some good money than rush into the market thinking that you will make money when you're under pressure. It's not going to work that way. You get it? So having all of these things at the back of your mind is going to aid you become a profitable trader. So quickly, I just want to talk about something real quick about Boom 1000, right? I want to talk about something real quick about Boom 1000. I'm going to talk about this, about Boom 1000. If you can see my screen, just leave a message in the chat box so I can know if you are seeing my screen. Can you see my screen? And he can see my screen. Okay. All right. That's it. Okay. So okay. All right. So I quickly want to show something about Boom 1000, right? I want to show something about Boom 1000. Boom 1000. Boom 1000 is a very wonderful pair. I love trading Boom 1000 a lot. And the reason I love trading it is simply because the profits are instant and the losses can be really minimized. You get? The only time you can make loss, a huge loss trading Boom 1000 or any of the boom and crash series is when you go against the spikes. When you trade against the spike, you are bound to make losses, basically, except you enter from a point where you know maybe you sold from a point like this, you sold from this point and the market fell down and you held the trade up until it got to this place. Basically, I mean, that's when you can now say, okay. But when you are trading against the spikes, the main goal of we trading this is to catch the spikes. We want to catch spikes. We want to be able to see. We don't want to trade against the spikes because we know going against the spike will end us in losses, basically. So first off, what do we do? The very first thing, take this down. The very first thing that you need to do when you're trading Boom 1000 or when you're trading boom and crash, identify the major trends. Identify the major trends. Now, if I put this on a 5 minutes time frame, we can look for a trend out of this place. We can do something like this. We can do something like this, right? This is a minor trend, basically. But before I do this, I would first of all identify the major trend so that I will have an idea where the market is coming from and where the market is going to. Do you get that? So first of all, identify the major trends. Now, identifying the major trends, you can identify the major trend on a weekly time frame. Sorry, you can identify it on a weekly time frame. You can still come down to a daily time frame. But I prefer using the weekly time frame because for me, I like catching very big moves. I mean, I like big money. I don't like small money. Do you get it? When I like big money, do you get? I like a situation whereby I catch a spike from its origin, and then I put my stop loss in profit. I lock the trade and leave it, go out, come back, and I discover that after the stuff spiked the first time, it spikes like 10 other times. Imagine you catching 10 spikes on boom 1000. Do you know what that is? Like, that is blood money. That's big money, basically. Do you get it? So first off, you need to identify the major trend. Look for where the major trend. Draw this. Keep it as it, like, let it be there. Now, secondly, when you want to, if this is exactly if maybe you are looking for a situation where you want to catch the market on a big move. Now, for us who are scalping, basically, what else do we do? After we first of all identify the market on a major trend, we still come down to smaller trends to identify the move of the market. Now, the main reason why I'm saying identify the market on a major trend first is because there are times, in fact, countless number of times that the markets will go beyond the trend. It will go outside of the trend. For example, put this here, and then the market can come to this place, which I suppose the market will come to this place and it will spike at this point. But many other times, the market can come down, break through this point, and when the market breaks through this minor trend, is looking for the next minor trend or the major trend. Do you get? Remember, our goal is to catch spikes. We are not trading against the spike. We can trade against the spike if we want to, but our goal is to catch spikes. And so we need to work with the trend. One of the things that you need to understand or put at the back of your mind is that boom 1000 follows the trend. It follows the trend. It follows the trend very well. Many a times when it breaks a particular region in the market, it's going to another region to take a spike from there. Do you get it? So as a trader, you need to understand this. If you actually want to be good in catching spikes on boom 1000, I mean, some of you have seen my trades where I caught some very crazy spikes, and I do that all of the time. You discover that it follows the trend. It follows the trend. Look at this point here on the market. Look at this. This part where I just drew this line. Now, this is exactly, it follows the trend. If I should put this on a lower time frame, look at this. Just look at what happened here. It got here and it spiked. And this is how I make sometimes when I tell people I catch like 10 spikes in a day, and they're like, how on earth are you doing that? It's just simply one trend. I came up to the market and I saw this. Okay, I was like, okay. And I caught the first one, second one, third one, fourth. And just imagine that. Do you get? So the major thing you need to understand when you want to catch spikes on boom 1000 is that you must follow the trend. After identifying the big trend, come down to smaller time frames. Put smaller trends inside, because what we are actually going to work with, the major trends connect the future to the past. The major trends connect the future movement of the market or the present movement of the market to what has happened in the time past. So based on that, we can now make our forecast and say, okay, the market may spike at this place. And then when the market gets to that point, I enter a trade. Do you get? Or maybe what I do many of the times is that this is exactly what I do. When I have a big account, let's say I have what are these people? Okay. Sorry for that. I need to mute these people. All right. Is this C4 Makwa or something like that? Please, can you mute yourself? You are causing interference. All right. So what was I saying? So if I have a $500 in my account and I want to make some very crazy money, right? What I do is that I just, maybe I put 5.0 or 10.0, basically. or maybe I put 5.0 to 2 or 3 positions. That's what I do many of the times. And I catch one spike and it's giving me like $400. And someone is like, guy, how did you do this? Do you get it? So many of the times, what I do, I look for after I finish, I put the major trend so that I can know where the market is going to and where it's coming from. I come down to smaller trends and then I begin to map out the current trend that the market is following or may likely follow. Remember, when we're doing analysis, we are not correct, actually. Our analysis are not correct in place. Even if you know what will happen in the market, do you get? I mean, the market can break its zone. Something can happen. The market may not reach that place. Do you get? So everything we are doing in our analysis and our forecasting, we are actually working with the most probable movement of the market. We are like, okay, this is more likely to occur. Do you get? And so the very first thing that we do is, right, where are the 2 points? Can we draw a trend here? We put a trend, right? And we're expecting that when the market gets to this trend, it will spike. Basically, that is exactly one of the things we're looking for. So now, how do I know where to put my, now, look at this. First, I identify the trend. This is a minor trend. I identify the minor trend. And then the next thing to do, I can come to these areas and start looking for the most possible areas or support areas or resistance areas on the trend that are closer to the support or resistance areas on the chart that are closer to this trend. Do you get? To where I'm expecting the market to spike from. The market can spike from this point as it is because we have something like this. This area is like a support area. Basically, the market can actually take off from this point, or the market can actually take off from this point. Do you get? This is more like a resistance area. Do you get? The market can actually still take off from maybe somewhere around here. Do you get? Why? Because we have all these little, this is a minor support area. Since we are working on a minor trend, all we are looking for is going to be on minor zones, basically. Do you get? So what am I doing? I am trying to look for the best place to enter the market, right? So after I've drawn this trend here, the next thing, I take a line and I'm like, okay, where's the possible place? Where can this market get to? It has broken the closest support zone, right? That means it should be heading to the next support zone, right? And then I can be looking for where can the market, let me look for little places on the market. Basically, that's exactly what I'm doing. Now, I can put my buy limit. Okay. I can place a buy stop at this point here, or buy limit here. I can place a buy limit at this point here. But what I do more often is that I've had situations, now look at this, I've had situations that the market gets very close to my buy limit and it did not pick it. I mean, I'm talking about very close, like I'm talking about close to, like very close, and it did not pick it. So what I do many of the times is that when I get a particular spot or a level on the market where I'm expecting the spike to take place from, what I do is that I set my buy limit or my buy order above that area. Do you get it? I set my buy order above that area, buy limit above that area. So first we identify the minor trend, we identify the major trend, and then we identify the minor trend, and then we look for support areas or resistance areas that can resonate or that are close to the point where this market is likely to take off from, to spike from. Do you get? And then we place our buy limit some pips above that line. Do you get? So the markets can actually come down here, takes this stuff, and then all of a sudden it spikes. Do you get it? And then when I do this, I set my stop loss some meters or some pips below the actual point I picked. Do you get it? Now, the main reason why I'm setting this above is so that the market will not get to this point, get close to my stop, don't pick it, and then it spikes. Do you get? So if I am doing this, after I set this, the next thing I do is to set what? My stop loss below this area. Now look at this. Let me modify this trade. I'm going to set my stop loss below. I'm going to set my stop loss below. Let me just make this 1. So I can put my stop loss at the next support or below the next minor support after this line. Below the next minor support. Do you get it? Now, this is the support area. Where I place this line is a minor support area. Look at this. Oh my God. Oh my God. Oh my God. Look at this. Look at this little area here. Also look at this point here. It's a minor support area. Do you get it? It's a pure minor support area. So I am placing my my expected zone around this area because it is closer to the trend. Now I put my buy limit above that area I marked. Do you get it? So that the market will pick my trade before it gets to the trend and then it spikes. I don't want a situation whereby it gets close to my trade, it doesn't pick it, and then it spikes off. Do you get it? And then my stop loss, just in case, is going to be below the next support zone. Do you get it? Now, look at this support zone here. Look at this resistance here. Look at this support. Look at this resistance. Look at this support. Do you get this? Look at this support. Do you get this? Look at this resistance. Now, this is more like a minor zone. So I place my stop loss below that area. Do you get it? Now, when I do that, the market can come, go beyond this trend line. It can break this trend line and then start going down. My stop loss helps me to minimize my risk, basically. It helps me minimize my losses. Do you get? The market can actually pick my stuff and spike. Do you get it? So on either ways, I am secured. I'm expecting the market to get to this minor trend and then for it to spike. Do you get? So that is actually how, personally, that's how I catch my spikes. And a lot of people are like, guy, how do you do this thing? Guy, nobody do be that. How do you? I mean, this is it. If you look back, if you check back in the chart, you will discover that this boom 1000 actually works with the trend all of the time. Look at this. Even this one that is as though it's coming downwards. Look at this. I've been in situations where I have to catch trades like this. I've been in situations where I have to catch trades like this, where the market spiked and then it came down. I'm expecting it to get to this line again, and I've caught trades both back and front on Deriv. I've caught spikes like this, both the one that it spikes normally and the one that it comes as though it's coming down. And it's spike, I catch all of them. Why? Because of this same strategy of following the trend. Once you want to catch a spike on Deriv, first things first, look for the trend. I mean, we can see this littered all over Deriv. Look for the closest trend, look for the trend, and then mark the trend. Once you mark the trend, all right, allow the magic to play. Do you get it? So that is that for Boom 1000. And this same strategy, you just need to apply it in crash also. That same thing, if you know that crash is always coming down. It is spiking downwards, and Boom 1000 is always spiking upwards, basically. Did you get that? So currently, I'm not going to give any signal for Boom 1000 just so that we can be on the safe side. Do you get it? And by the safe side, I mean that currently, if you look at the market, it's consolidating. So I don't want a situation whereby I give you a signal and all of a sudden it hits your stop loss all of the time. And trust me, I will not give you a buy signal. The only thing I'm not going to give you a sell signal on Boom 1000. But subsequently, when I find areas on the market, that's why you just need to keep your account funded. When I find areas on the market where I'm more likely for spikes to occur, I would definitely let you know. I'll just tell you, buy at this point, buy here, and then you buy, and of course, spikes will happen. Do you get that? So basically, this is one of the biggest things I used to make huge profit on Deriv. Do you get that? Catching spikes. First off, identify the major trend. And the main reason why we're doing this is to know where the market is coming from and where it's going to. Many a times, like for example, what we are seeing here now, this is a pure downtrend, right? This is a downtrend. The market is actually coming down to this area. It's still coming down to this area. But on the minor trend, we can still use the minor trend to look for spikes, basically. Do you get it? But if you can catch the market when it comes down to this major trend, I mean, oh my God, if you catch a spike from this major trend, you are made. Because just look at this on a weekly. If you catch a spike on the major trend, you are made. Do you get this? So we are looking little spikes on the minor trend, but much more, we want to know where the market is coming from and where it's going to, and then possibly catch the next move of the market from the major spot. That's why you need to identify first the major trend before going in to look for minor trends. You can look for minor trends on 1 hour time frame. You can look for it on 30 minutes, on 5 minutes, on 15 minutes, and even 1 minute, basically. You can look for that on all of these time frames. Do you get that? You can actually look for spikes on all of these time frames. Do you get that? So that is exactly that. That's for Boom 1000. This is my money-making strategy. This is my money-making. I'm telling you, this is my money-making strategy. I mean, this is it. This, you don't need all of these robots and whatever that blows up your account. No, this is pure price action. No indicators here. All we are just doing is identifying the trend, taking trades, catching spikes, making money, and smiling to the bank, basically. Do you get that? So that is that. And I actually wanted to talk a bit about V75-1S, Volatility 75-1S. Volatility 75-1S is one of my very sweet. Before I leave, Boom, look at this. Look at this. Look at this. You can also put trends. You can also mark minor trends like this on higher time frames. Do you get this? And the main reason why you are marking all of these trends, many a times if you come to my chart on a normal day when I'm trying to analyze for spikes, you can see lots of trends on different time frames. And the main reason why I'm putting all of those trends is so that I can tell where the market is maybe going to. For example, if the market should break through this trend, I'm expecting it to come to this bigger trend. Do you get? If it doesn't spike here, it's going to spike here. So when it kicks me out, all I'm waiting for the market to get to this area for me to pick my spike. Do you get it? So this is part, I mean, you should form, if you want to catch spikes, just form the habit of drawing trends. Just form the habit of drawing trends on your chart. Once you're able to do that, you'll be able to tell where the market is going to be. You get? So, like I said, I wanted to talk a bit about V75-1S before I shut down. What's the time now? What's the time? Oh, 10:25. Seriously. I mean, we've gone so far. Yeah. Okay, I don't know if there's still going to be a little bit of time to talk about this, but for me, I really like V75-1S because it is it is not as volatile as V75 on a small account. If you look at many of the trades that I post on the group that I grew $7 to $400, $300, check the assets. It is V75-1S. That's my secret. If I want to grow small account, I look for V75-1S. It is whenever I catch a small account, all I'm looking at is if I tell you I want to trade a small account, it is V75-1S. Now, let me just tell you this. On Sunday, I was to go to church. I was to go to a different place, not my normal branch, basically. So I took a trade on I called my friend. That was on Saturday night. And then I called and was like, guy, Alpha, that your account, is it still funded? He said, yes. And then I was like, send me the login and all of that. He sent it to me. And then I was like, okay. I took a trade and Deriv kicked me out. On V75 1S. And it was a $5 account, basically. And the account dropped from $5 to like 3 point something dollars. So I entered another trade and took the account from $3 to $9. So when it got to $9, right? When it got to $9, I was now ready to go full margin on Deriv. I wanted to bastardize Deriv. Do you get? And then guess what? I entered that trade on Sunday morning. I left for church. I did not check the trade. I did not even know what was happening. I entered 0.15, 2 positions. It was, I think, a sell. Yeah. It was a sell. I can't remember. Was it a sell or a buy? I can't remember. I left the stuff. I went out. I left home around 8 a.m. in the morning. And then by getting back home, it was like past 4 to 5 in the evening, basically. And then after all of that, I was like, come on. When I got back home, I finished eating, and then I remembered, oh, I had a trade running. And guess what? I went into that account, and that account that was $9, automatically I saw $139 with volatility 75 1S. Do you get that? So if you want to grow small accounts, basically, one of the major things to use is volatility. Use non-volatile pairs that are not very volatile. You'll be able to grow your account very well. And guess what? When you do your analysis properly, you know what you're expecting on the market. For example, I cannot just jump into the market anywhere. I know what I'm expecting on the market, basically. And then the next thing I do, I look for a good entry. I enter the market, set my stop loss, I run away. Do you get it? That's exactly what I do. That is exactly what I do. I look for a good entry, enter the market, I run away. Many of the times, I come back to make profit. Sometimes it has entered profit and it has retraced and kicked me out. But guess what? As a good trader, I still know what to do. I'm not moved. I'm not taking revenge trades, so I'm not losing. Do you get it? What do you say about taking $7 to $150 to $130 in less than 12 hours? Come on, what would you call that? Is that not witchcraft? Do you get it? Basically, these are part of the things I use to grow small accounts. These are my power strategies for growing small accounts. So you want to grow a small account, you have a small account. Don't be looking for volatility 75. It will blow your money. Don't go and sell boom 1,000. It will blow your money. Don't go and sell crash 1,000. It will blow. Don't go and buy crash 1,000. It will blow your money. Look for less volatile pairs like volatility 75 1S, volatility 25. Volatility 25 is a bit volatile, but it's not very, very volatile. It can grow your account. Do you get it? So when you can use all of this to grow your account, many of the times what I do is that I grow a small account from, let's say, $7 to $100, or $7 or $10 to, let's say, $150 or $200, and then I take 2 or 3 spikes on 1,000. And guess what? The account moves from $10 to $200. From $200, it moves to, let's say, $400 or $500. Do you get it? That is it, basically. This is my power strategy. Do you get that? So you want to actually make money from Deriv. See, look for the profit spots that are peculiar to you. Personally, for me, my friend knows me very well. There was a time I was calling myself God of lot size. If I wanted to change my name on social media to lot size, because I like opening lot sizes. If you check, I like opening lot size. And if you look at my account size and my lot size, they can never be matched. Like, you will see somebody opening 0.25, 4 positions on a $10 account. And you're like, God, what exactly are you doing? Do you get it? And then it turns out to be profit. And you're like, how do you grow small account? It is because of I look for something that is peculiar with me on the market and I go for it, basically. Do you get that? So that is that for this. Tomorrow, we are going to go extensively. We're going to talk about major pairs. We're going to talk about supply and demand zones. My friend Lawal is really loaded for this. Do you get it? And keep an eye open, keep an eye on the group. Maybe anytime signals are going to drop. Do you get? For me, I'm waiting for the next buy move on Boom 1000. Do you get? I want to catch that spike from the bottom. I want to start catching the spikes from the bottom. Do you get it? Do not form that habit of, don't be addicted to trading. If not, you be addicted to losses, basically. Don't be addicted to trading. Don't put all of the time you want to trade. I mean, there are some people just jump like, market is on, like market is open and I'm not in a trade. What is happening? Do you get that? Don't, basically, because if you try that, you will lose. Do you get? If you try that, you would lose. Always mark your setups and expect the market to come to you. Don't fight with the market. It's not your dad that owns it. Do you get it? Don't fight with the market. If you fight with the market, you will definitely get bruises on your account. Do you get? So you have a small account, look for pairs that are very, very, very less volatile and can still give you profit over time. Once you can move your account, maybe your $10 account, your $20 account, you can move it from $20 to, let's say, $30, $40 with all of these pairs. It will be very easy for you to take some volatile trades and make more profit. Do you get it? That's why my friend, when he gives signals, is like, if your account is small and don't take this trade, don't do this. Do you get that? It's simply because of that. But if your account size is of standard, it's of level, it can handle the pressure of a trade. The truth is, Deriv is not here. Deriv is a business. You get? They're not here to make you rich. They're not here to give you $1,000 withdrawal. They're not here to give you $2,000. They want to collect your money. Do you get that? And so you are also in business, the business of trading. You need to look for all of the possible means that will make you not to give Deriv your money, even if you know that it is inevitable. But try as much as possible not to put yourself in that situation where you make the process of loss possible. Do you get? Do not try to make losses possible. If losses happen, they happen. Do you get that? So that is that for this. Tomorrow, we're going to talk about some things extensively, and definitely we will drop some setups for you and some signals, what we're expecting on the market and what you should buy, what you should take, the trades you should take. That definitely, see, the fact that you're working with us, you're going to make money. You're going to make money, definitely. We did this last year. A lot of people made money. Do you get? And we're on this year again. We're on. It's a rampage. We are on. People must make money, basically. So just in case you have questions, I don't know, anyone, you have questions and stuff like that, you want to, do you get? I'll be willing to listen to your questions, basically. Anyone with questions? If you have questions, you just ask them. But just in case you don't have questions, I think this is okay for today. 1,000 and the 75 one is for your small accounts. You get that? Just in case you don't have questions or you're afraid to ask them on the group, on the call currently, you could write them down. All right, the smallest lot size for Volatility 75-1S is the smallest lot size for Volatility 75-1S, it is 0.005. 0.005. But the 0.005 would not give you anything. It's a good something. You can actually trade it. You get, but when you compare that with 0.15, okay. So for an account of $50, it depends on your rig. Okay. Now, for an account of $50, it depends on your risk, basically. If you actually, for me, what I do many of the times is that if I have, let's say, if I fund $50 in my Deriv account, that's one of the ways I manage seemingly small accounts. If I want to trade a big account, my account is big. Do you get? If I want to trade a small account, my account is small. When I mean small, it is always small. Do you get that? So what I do is that I take out, maybe if I fund $50, I can take out, let's say, $30, and I leave it in my USD wallet in deriv.app. Do you get? And then I leave $20 in my trading account. And when I leave that $20 in my trading account, for me, I can open 0.15. Do you get? I can open 0.25, 3 positions. It depends on your risk. It depends on your risk appetite. What are you willing to risk? What are you willing to lose? Do you get? If my risk appetite is up to 50, if I'm willing to lose $50, I can open 0.25, 5 positions and leave it and go away. And I will come back definitely and I will make profits. Do you get? So for an account of $50, okay, something around, depending on your risk. But for me, if I had an account of $50, I will not open anything less than 0.25, about 3 positions. Do you get it? Because my risk appetite can carry a loss of $50. Do you get that? And then someone else asks, if I take profit when a spike occurs, right? Many times, what I do is when I identify my trend, when I put my trend and I'm expecting a spike to occur, okay, just imagine, look at this. Look at this. Now, I said something earlier on. I was saying something about the fact that the market can get to the minor trend and break that area. And that's why you need to have lots of trends on your boom 1000 or your boom and crash, basically. Do you get? So what I do is when a spike occurs, like if I'm picking a spike from the origin, once the spike occurs, what I do is I put my stop loss just above my entry. Because if I'm picking the spike from origin, do you get? If I'm picking the spike from origin, that is not going to be the only spike. When the spike begins from origin, it can, for example, look at this. The first spike happened, the second, and then there was a little whatever, and then it was still spiking up until this point. So if I caught the market from this point here, I will definitely hold it till it gets to this point. Do you get it? I will definitely hold. And then when it gets to this point, it can now drop a bit. Drop a bit. If I see that the drop is getting out of hand. But guess what? I've held that trade from here up until here. So when the market spikes and I catch the spike from an origin, a trend, do you get? I allow the spike, I put my stop loss in profit. Many a times it may not be, many a times it may not spike from just very, from above where the first spike took place from, but it can still come back to the trend and spike. For example, something like this can happen. It can spike from here, go up here, and then still come down to this trend. And then maybe your stop loss is just here, it will just kick you out. But for me, once it spikes, I set my stop loss in profit. If I see that it's coming to the trend, I may close the trade and allow it to come back to the trend. If it comes back to the trend, I enter based on my normal analysis. And then if it gets back here and it spikes again, I know definitely that it's going to continue spiking on this. Do you get that? So if I take a trade, if I catch a spike on boom 1000, I don't close it. I set my stop loss in profit and then catch the other spikes. Or just in case I entered late and I was so lucky to still catch a spike, basically. Do you get? If it spikes, many a times, if the spike is long and crazy, I can just exit the market because I know that after every major long spike, many a times the market can retrace and come back to the trend. Do you get that? So that is that. So for this, I'm expecting the market to still come back here. If the market breaks this point, then I should be expecting the market to come down to, okay. I should be expecting the market to come down to the major trend, or exactly, I should be expecting the market to come down to the major trend. Now, this market has been falling for since last week. Since last week, I personally have been looking for moves on Boom 1000 basically, but throughout last week and this week, I've not traded Boom 1000 because I discovered that it's in a bearish move and it's coming back to this major trend. So all I am just putting my forces together for is to catch the market from this area. So that is that. Any more questions? Any more questions? Any more questions? Okay, this person that asked what will work perfectly, you're still talking about the lot size for a $50 account on V75 For me, like I said, it depends on your risk appetite. You need to put it into consideration. The fact that I do it doesn't mean you should do it. Do you get? I can give you a correct signal and tell you enter so and so lot size. And then you enter the lot size, and maybe the floating loss you see here is like $4, and then you are fidgeting. And then you can even close the trade. Meanwhile, I am still in that trade, and I'm going to still make profits, basically. So first thing you have to understand is, what are you willing to risk? If you can risk $20, if you can risk whatever on that account, you can open as much lot sizes. But for me, if I have a $50 account, I would open 0.25 lot size, like 3 or 4 or 5 positions, basically. Why? Because my risk appetite can handle anything like that. Do you get it? So that is that. Any more questions? I think we're already running out of time. We're running out of time, basically. We are running out of time. All right, any more questions? If you have more questions, just leave it on the group. Mr. Lawal, are you still there? Do you have anything to say tonight?
No, it's fine.
All right. Thank you very much, guys. So tomorrow we're still going to continue, and then we're going to talk about so many things deeply, right? Today, I just talked about Boom 1000. I talked about managing a small account, and then your trading psychology, and then we did an overview. Tomorrow, we're going to talk about something more in-depth, and we believe and we know. Keep your eyes open. Keep your eyes on the group. Signals will drop anytime, and money will flow. Thank you very much, guys. Have a wonderful night rest. Good evening.